All right, listen up. Today, I'm pulling back the curtain on how smart money actually moves the market. I'm stepping into my role as your prop trading mentor right now. We're breaking down the liquidity sweep reversal strategy in this explainer. It's strict, it's rule-based, and honestly, it strips away all the guesswork so you can finally see exactly why price does what it does. The very first mindset shift you need to make today, realizing that true professionals literally wait for the trap to spring before committing a single dime of capital. We do not trade breakouts. We trade the trap after the breakout. Look, retail traders see a key level break, and they just blindly jump in out of FOMO. But smart money, they see that exact same level break as the perfect opportunity to set a trap. Seriously, how many times have you been frustrated getting stopped out on what looked like a flawless breakout? It's maddening, right? Well, it happens because institutional market makers are actively hunting you. They have massive orders to fill, and they need immense liquidity to do it. And guess where that liquidity is sitting? Right at your stop losses. They engineer these moves to hit your stops, grab the liquidity they need, and then they reverse to price. So here is your playbook for today. We'll cover the institutional liquidity trap, strict New York session timing, our 5-step playbook, how to execute both sell and buy trades, and finally, the golden rules for prop traders. Let's get right into it. Starting with part 1, the institutional liquidity trap itself. The institutional logic is actually pretty brilliant, and it happens in 3 exact steps. First, they push the price to trap retail traders into taking that breakout trade. Second, they push it just a little bit further to grab the stop losses of the folks who are already positioned the other way. That right there is the liquidity grab. And third, now that they've hoovered up all those orders, they reverse the price from a strong institutional zone into the actual intended direction. If you take one thing away today, make it this mantra: liquidity first, move later. I need you to burn this into your trading psychology. You do absolutely nothing until smart money has grabbed their liquidity. If you don't see the sweep, you don't have a trade, period. Moving to section 2, strict New York session timing. You are only allowed to execute these trades during a very specific 2-hour window, 8 a.m. to 10 a.m. New York time. Why? Because this entire strategy relies heavily on the massive wave of institutional volume that floods the market when New York wakes up. If you try to force this setup in a low volume, dead market, you're just going to get chopped up. True discipline means waiting for the right time. And during that 2-hour window, keep your eyes on just 3 assets: EUR USD, GBP USD, and gold. Honestly, gold is our absolute best performer for this specific strategy. These pairs give you the perfect mix of tight spreads, high liquidity, and really clear institutional footprints. Keep your charts clean and just stick to these 3. Okay, section 3. Let's open up the actual 5-step playbook. There's a massive contrast in mindset here. The retail approach is totally reactive to the current candle. They just buy the breakout the exact second a level breaks. But your new approach at the prop desk, completely different. We anticipate. We wait patiently for the stop hunt to finish, we let the trap snap shut on the retail money, and then we buy the reversal. Before we even look at a setup, memorize this term: market structure break, or MSB. This is your ultimate green light. Look, even after a liquidity sweep happens, you never just enter blindly. You wait for the price to actually prove it's reversing by breaking structure. That means making a lower low if you're looking to sell, or a higher high if you want to buy. Without an MSB confirming the move, you simply don't have a valid trade. Let's jump into section 4 and actually execute a sell trade. Let's walk through a real setup step by step. Step 1. Before the New York session even opens, you draw a line at the previous day high, the PDH. This is the exact spot where retail stop losses are resting. Step 2, the 8 a.m. bell rings and you watch price aggressively push above that PDH. Retail is buying the breakout, literally volunteering to fund the market makers. Then, step 3, a long wick forms, it completely rejects, and the candle closes back below the PDH line. It's a fake out. The trap is officially set, but we still do nothing. Now, we wait for that confirmation. Price drops heavily and breaks the previous low. Bam. There is your market structure break. Once we have the MSB, we identify our supply zone by finding the last up candle right before that big drop. Now, you set your trap. You wait patiently for price to retrace right back into that supply zone, and you snipe your sell exactly there. Your stop loss goes strictly just above the tip of that long rejection wick, and you target the previous day low for your take profit. You are literally trading from liquidity to liquidity. Section 5. Let's flip the script and execute a buy trade. First, you've got your previous day low marked. The window opens and you watch the price tank below the PDL. Retail traders start panic selling the breakdown. But wait, a crucial long wick forms, rejecting those lows, and the candle closes back above the line. Smart money just bought up all those retail sell stops. Finally, to prove they've taken control, price surges and breaks the previous high. There's your market structure break. With that confirmation locked in, you find the final down candle right before that big rally. Highlight that area. That's your demand zone. Do not chase the rally. Just stay calm and enter only when price naturally retests that demand zone. Drop a strict stop loss safely below the absolute bottom of that rejection wick and aim for the previous day high as your target. Simple, clean, disciplined. Finally, Section 6, the prop trader golden rules. 1 to 3. That's your minimum required risk-to-reward ratio. If the distance to your stop loss compared to your take profit doesn't give you at least 3 times your risk, walk away. Seriously, no exceptions. This specific math is what lets you run a high win rate strategy while heavily protecting your capital when you inevitably get one wrong. Burn these rules into your brain right now. You only trade the New York Open. You never ever enter a position without seeing a clear liquidity sweep of a previous day's high or low. You never enter without an MSB confirmation. And finally, 1 to 2 trades per day max. Overtrading and skipping confirmations, that is the absolute fastest way to blow an account. We are hunting for high probability, not constant action. The most profitable traders I've ever mentored fundamentally understand this single quote. You are not predicting, you are reacting. We don't have crystal balls. We don't guess where the market is going before it moves. We just let the market makers show their hand, build their trap, and then we calmly react to the footprints they leave behind in those supply and demand zones. So I'll leave you with this question. Are you ready to stop trading like the retail crowd and start capitalizing on the trap? It's entirely in your hands now. Review this explainer, go mark up your charts with those previous day highs and lows, trace out the structure breaks, and really ask yourself, do you finally have the discipline to wait for the sweep? Because honestly, that is where your edge truly lies. Stick to the rules, and I'll catch you next time.